Hello. Today we will discuss about the basic concepts of process costing. So, in process costing, what is the meaning of process costing? The meaning of process costing is it is a method of costing applied in the industries engaged in continuous or mass production. Process costing is a method of costing used to ascertain the cost of a product at each process or stage of manufacturing. Uh, Definition as per CIMA terminology, the definition of process costing is that form of operation costing which applies where standardized goods are produced. So, what is the purpose of process costing? To control the process. It helps to control the overall process of making product. To know cumulative cost, it helps to know the total cost for all process. To calculate the value of inventory of raw material, work in progress and finished goods at the end of the period. It is also used to assign price of the products. The characteristics of process costing is the production is continuous, the products pass through two or more distinct processes of completion, the products are standardized and homogeneous, products are not distinguishable in processing stage, the finished product of one process becomes the raw material of the subsequent process, cost of material, labor and overheads are collected for each process and charged accordingly. So, there are few advantages of process costing. First one is it is easy to compute average cost because the products are homogeneous in process costing. It is possible to ascertain the process costs in a short intervals. Process costing is simple and less expensive in relation to job costing. By evaluating the performance of each process, effective managerial control is possible. And few disadvantages also. Valuation of work in progress is difficult. It is not easy to value losses, wastes, scraps, etc. The apportionment of total cost among joint products and byproducts is difficult. Process costs are not accurate, they are only average costs. Process costs are only historical. The principles of process costing are as given below. The following points are considered while determining the cost under process costing. Production activity should be divided into different processes or departments. A separate account is opened for each process. Both direct and indirect costs are collected for each process. The quantity of output and costs are recorded in the respective process accounts. The cost per unit is determined by dividing the total cost at the end of each process by the number of output of each process. The normal loss and abnormal loss are credited in the process account. The accumulated cost of each process is transferred to subsequent process along with output. The output of the last process along with cost is transferred to finished goods account. In case of byproducts, the joint products, their share in joint cost should be estimated and credited to the process. When there is work in progress at the end of the period, the computation of inventory is made in terms of complete units. The application of process costing it happens in following circumstances where the production is standardized, where production is continuous and undertaken on a large scale, where it is not possible to distinguish the product during the processing stage, when the output of one process becomes the input of next process, when the output is uniform and all units are exactly identical during one or more processes. So, there is a difference, there are few differences between process costing and the job costing. In case of process costing, production is continuous. In case of job costing, production is according to customers' orders. In case of process costing, production is for stock. In case of job costing, production is not for stock. All units produced are identical or homogeneous. each job is different from the other. There is a regular transfer of cost of one process to subsequent processes. There is no regular transfer of cost from one job to another. Work in progress always exists. Work in progress may or may not exist. So, in case of job costing, the production is against the customer's specific orders. In case of process costing, the production is continuous. Production is not for stock in case of job costing, but in process costing, production is for stock. Each job is different from others in the case of job costing. In case of process costing, all units produced are homogeneous. There is no regular transfer of cost from one job to another in case of job costing. There is always transfer of cost of one process to subsequent processes. Costs are accumulated for each job. Costs are accumulated for each process for a period. Work in progress may or may not exist. Work in progress always exists. Cost is ascertained when job is complete. Cost is ascertained at the end of cost period. So, what are the procedure for process costing? Each process is separately identified. Separate process account is opened for each process. So, separate process account needs to be opened. Along with the particulars column, two columns are provided on both sides of process account: units and amount. All the expenses are debited in the respective process account. Wastage, sale of scrap, byproducts, etc. on the credit side of the process account. Procedure for process costing: the difference between debit and credit side shows the cost of production and output of that particular process, which is transferred to the next process. The cost per unit in every process is calculated by dividing the net cost by output. The output of last process is transferred to the finished stock account, and the incomplete units at the end of each period is on every process, right, converted in terms of completed units. So, preparation for process account. These are the various cases. First one is the simple process account, process costing with normal process losses, process costing with abnormal process losses, process costing with process gains, valuation of work in progress, inter-process profits, and joint product and byproduct costing. So, a specimen of process account, it looks like this. So, on the left hand side, we write direct material, direct wages, direct expenses, indirect expenses and other expenses. In right hand side, we have loss of weight, that is the normal loss, sale of scrap, and the balance, it goes to the next process, next step of the process. So, simple process account, under this case, it is very easy to prepare the process account. A separate account is opened for each process. All costs are debited to the process account. The total cost of the process is transferred to the next process. At the end of each process, the cost per unit is obtained by dividing the total cost by the number of units. So, process loss is that quantity lost in the process by way of waste, scrap or spoilage. The process loss is classified into two: normal process loss and the abnormal process loss. So, what is process loss? The process loss is classified into two parts. One is normal process loss and another one is abnormal process loss. Normal process loss is, this is the loss which is unavoidable on account of inherent nature of production process. It arises in normal conditions. It is usually calculated as a certain percentage of input. The normal process loss includes either waste or scrap or both. There will be another S, or scrap or both. So, normal loss is the loss which is unavoidable and it arises under normal conditions. It is calculated as certain percentage of input. Normal loss in weight is equal to opening stock plus output from preceding process minus output of the concerned process plus closing stock. So, normal loss is waste is unsellable and has no value. Loss in weight is an example of waste. Loss in weight should be credited to the concerned process account. It should be recorded only in terms of the quantity. Formula for calculating normal loss is loss of weight is opening stock plus output from the preceding process minus output of the concerned process plus closing stock. So, the difference between the two, what it is receiving from the preceding stock plus opening stock minus the output of the current process plus closing stock, this will give you the normal loss, right, that is unavoidable. Sometimes the scrap also happens. Sometimes normal loss may have some realizable value. In that case, it is called a scrap, right. So, the damaged goods may be sold as scrap. Revenue arising from the scrap should be treated as a reduction in cost rather than an increase in sales revenue. So, what is the accounting treatment? Normal loss accounting treatment is it is unavoidable, expected, so there is no entry. Abnormal loss, excess loss over the normal loss, right. So, it is abnormal loss debit to process account. And in case of gain, if there is any gain happen, that means the actual loss is less than the normal loss. In that case, we say it is an abnormal gain. In that case, we do like this: process account debit to abnormal gain. Scrap value, if the normal loss can be sold and some amount may be realized, in that case the accounting entry is scrap account debit to process account. Scrap value of abnormal loss, if there is some abnormal loss, that is a loss which is beyond the normal loss, some extra loss, and if it has some marketable value, then I can pass this entry scrap account debit to abnormal loss account. Loss of scrap value due to abnormal gain. So, if there is any gain, that is the actual loss is less than the normal loss, and if it is realizable something, then I can pass this entry debit abnormal gain, credit scrap. So, abnormal process loss, that is any loss caused by unexpected or abnormal conditions such as plant breakdown or substandard material or carelessness or accident, etc., or loss in exceeds the margin anticipated for normal process loss, can be called as abnormal process loss. It is controllable and avoidable. So, abnormal process loss, when actual loss in the process is greater than the estimated normal loss, it is a case of abnormal loss. It may also be determined by comparing the actual output with expected or normal output. If actual output is less than the normal output, the difference is abnormal loss. So, value of abnormal loss is normal cost of normal output into units of abnormal loss divided by normal output. Normal cost of normal output is total expenditure, that is total debit of process account minus sale proceeds of scrap, right. So, normal output is equal to input minus units of normal loss. So, abnormal gain, sometimes the actual loss or the wastage in a process is less than the expected normal loss. In this case, the difference between the actual loss and the expected loss is known as abnormal gain or abnormal effective. So, it is the excess of actual production over the normal output. Abnormal gain is valued in the same manner as abnormal loss. The value of abnormal gain is debited to process account and credited to abnormal gain account. The value of scrap is debited to abnormal gain account and credited to normal loss account. So, finally, the abnormal loss account is closed by transferring the credit balance to costing profit and loss account. So, value of abnormal gain, how to calculate it? Normal cost of normal output into units of abnormal gain divided by normal output. So, normal cost of normal output is total expenditure minus sale proceed of scrap normal output, that is input minus units of normal loss. So, units of abnormal gain is equal to normal loss minus actual loss, or actual output minus normal output. So, abnormal gain is basically where you are expecting a kind of normal loss, but your actual loss is less than that. So, that is a example of abnormal gain. So, what is the difference between normal loss and abnormal loss? It is unavoidable in case of normal loss. In case of abnormal loss, it is avoidable. Normal loss is recurring in nature, abnormal loss is accidental in nature. Normal loss can be estimated in advance, the abnormal loss cannot be estimated in advance. Normal loss, it is found as input expected percentage of normal loss, and abnormal loss, it is found as input normal loss minus actual output. In case of normal loss, if it is a waste, it is recorded as a quantity column on the credit of the process account. If it is scrap, the sale of scrap is recorded in the quantity column and value column on the. So, if it is in case of normal loss, if it is a waste, it is recorded in the quantity column on the credit of the process account. If it is a scrap, the sale of scrap is recorded in the quantity column and value column on the credit of process account. In case of abnormal loss, the realizable value of scrap is credited to abnormal loss account. Its cost is treated as part of the cost of product and is absorbed by output. It's in case of normal loss. In case of abnormal loss, its cost is not treated as part of the cost of product and is charged to the costing P&L account. The normal loss is a non-insurable loss and abnormal loss is an insurable loss. So, in many of the cases, in process account, there are some quantity which is unfinished, which is called work in progress. In most of the firms, manufacturing is on a continuous basis and the problem of work in progress is quite common. The work in progress consists of direct materials, direct wages and production overhead. The work in progress is also called unfinished units or incomplete units. Valuation of these incomplete units is a problem. It can be solved by calculating equivalent production. What is equivalent production? Equivalent production represents the production of a process in terms of completed units. In other words, it means converting the incomplete units into its equivalent of completed units. It is also known as effective production. For calculating equivalent production, work in progress needs to be inspected. Then an estimate is made of the degree of completion, usually on a percentage basis. Equivalent units of production. If there is no opening or closing stock in progress, then the unit cost of products can be obtained as follows. Unit cost is equal to sum of production cost divided by production quantity. Equivalent unit of production, however, is if there is an opening or closing work in progress, the partly completed production will have a lower cost than the fully completed production. We have to be converted the work in progress into finished equivalent units of production. So, what is the procedure for calculating the equivalent production? So, ascertain equivalent production in respect of work in progress, if any. In this case, the equivalent production is computed by taking into consideration the percentage of work required to finish now in the process. The following formula is used: opening WIP units into percentage of work needed to complete. Number 2, find the units introduced and completed and add these to 1. It is calculated as follows: unit completed and transferred minus opening WIP. Third, convert the equivalent production of closing work in progress and add to the above. The formula is closing WIP into percentage of work completed. Fourth, the total equivalent production terms of materials, labor and overhead separately if degree of completion is different. For this, the statement of equivalent production is prepared. The 5. Find out the net process cost, element-wise materials, labor and overheads. 6. Ascertain the cost per unit of equivalent production for each element of cost separately. So, material cost per unit is equal to material cost divided by equivalent production in respect of materials. Labor cost per unit is labor cost divided by equivalent production in respect of labor. Overhead cost per unit is equal to overhead cost divided by equivalent production in respect of overheads. 7. Find out the value of opening work in progress, finished units and closing work in progress. The formula is equivalent production in respect of materials into material cost per unit. Equivalent production in case of labors into labor cost per unit, equivalent production in respect of overhead into overhead cost per unit. So, now you can compute the equivalent production. The following is the first step in the computation of equivalent production. Start with opening WIP. It is to be converted into equivalent units by applying the percentage of work to be completed during the current period. For instance, if opening WIP is 40% already complete, 60% is to be completed during the current period. The following is the second step in the computation of equivalent production. Add to the first step the number of units introduced and completed during the period. It is found out by deducting the closing work in progress from the number of units introduced. These units are fully completed, hence the percentage of completion is 100%. The following is the third step in the computation of equivalent production. Add to the previous step the closing work in progress. To ascertain the equivalent unit, the percentage of work done is to be applied. So, this is an example. Opening WIP 2000 units, 40% complete, units put to process 15,000 and units completed 16,000. Closing WIP complete 1000 units, 60% complete. So, the opening WIP is 2000, percentage of completion is 60%. So, equivalent unit is 1200. Units introduced and completed 14,000, 100% complete. So, 100% complete. So, 100% complete. So, equivalent unit is 14,000 and closing WIP is 1000 units, percentage of completion 60%. So, 600 complete. So, if you add this 1200 plus 14,000 plus 600, it is coming to 15,800. So, opening WIP is 40% complete, 60% completed during the current period. Less units introduced is 15,000, less closing WIP. So, units introduced and completed is 14,000. So, methods of cost flows. There are two methods of cost flows in process costing: first in, first out and weighted average cost. First in, first out and weighted average cost. So, first in, first out method, the opening work in progress is the first group of units to be processed and completed during the current period, and it separates the cost computations of the opening work in progress and the current period production. In weighted average method, the opening work in progress is merged with the production of the current period to form one batch of production. The average cost per unit of the opening work in progress and the current period of production is same. Method of cost flows, in case of FIFO, first in first out method, the UP computation ignores the work performed on the opening work in progress during the prior period. So, cost per unit is current cost divided by equivalent units of production. In case of weighted average method, the UP computation includes all the work performed on the opening work in progress during the prior period, and cost per unit is equal to cost of OWIP divided by current cost divided by UP. So, there is one illustration. So, following expenses were incurred for the production of 1000 units of durable product. Material 3,50,000, wages 1 lakh, overheads 50,000. You are required to prepare the process account assuming there was no loss of units. So, to material it is units 1000, rupees 3,50,000, labor 1 lakh, overhead 50,000, and so it is transferred, finished goods it is stock, it is transferred 5 lakh total, right. Now, illustration 2, in a factory the output of product passes through two processes A and B. Prepare process accounts from the following details. So, direct material for A is 10,000, for B it is 6,000, direct wages for A it is 4,000, for B it is 2,000, chargeable expenses 8,000 for A, 4,000 for B, overheads amounting to 6,000 are to be apportioned on the basis of 100% of direct labor. So, we can create a process A account where direct material is 10,000, direct wages 4,000, chargeable expenses 8,000. So, to overheads 1,000 units it is 4,000. So, process B transfer is total 26,000. Then I am transferring process into process B, the 26,000. So, process B debit is 26,000, then again material is been added of 6,000, direct wages 2,000, chargeable expenses 4,000 and overheads 2,000. So, total is 40,000, and finished stock the total 40,000 is been transferred, right. Let us come to illustration 3. The product A passes through 3 distinct processes. The product is transferred to finished stock after the third process. Prepare the process accounts from the information given below. So, process 1 direct material is 4,000, process 2 is 600, process 3 is 550. Direct labor for process 1 is 1500, process 2 is 1600 and process 3 is 900. Direct expenses 650 for process 1, for process 2 it is 400. The total production overheads during the period was 6,000. It is to be apportioned to different processes on the basis of 150% of the direct labor. There is no opening or closing stock. Production during the period was 200 units. So, in process account, on the debit side, 2 direct material 4,000, so per unit is 20, direct labor 1500, per unit 7.50, direct expenses 650, that is 3.25, production overhead 2250, we will see the working for production overhead, per unit is 11.25. So, total for amount is 8,400, per unit it is coming 42. So, I am transferring this to process 2, transferred to process 2 8,400 and per unit is 42. So, in process 2 8,400 is been transferred from process 1. Then direct material of 600 is been added, per unit is 3, direct labor 1600, per unit is 8, direct expenses 400, it is 2, production overheads 2,400, per unit is 12. How this 2,400 come, we will show in working later on. So, then transferred to process from process 2 is 13,400 and it is 67,000, right. And then transfer from process 2 is 13,400, 67. So, direct material it is 550, 2.75, direct labor is 900, 4.50, the production overheads 1350, so per unit is 6.75, and then total 16,200 is transferring to next process and per unit cost is now 81. So, these are the working notes. So, I can calculate the production overhead. It is given in the question that the production overhead is 150 percent of direct labor. So, production overheads process 1 is 1500 into 150 by 100, that is 2250. For process 2 it is 1600 into 150 by 100, that is rupees 2400. For process 3 it is 900 into 150 by 100, that is rupees 1350. Now come to illustration 4. From the following information, prepare process account and normal loss account, right. So, input of raw material 2000 units into rupees 6 per unit, direct materials rupees 10,400, direct wages rupees 10,000, the production of overheads 6,000, actual output to process 2 1900 units, normal loss 5%, value of scrap per unit rupees 4. So, process 1 units introduced is 2000, so it is 12,000, direct material 10,400, direct wages 10,000, production overheads 6,000. So, by normal loss 5% of 2000, it is 100 units, it is 400. So, transferred to the next process is 1900 units and its value is now 38,000. So, normal loss account we can create like this, that from to process account it is 100, so 400. So, by cash it is 400. So, cost per unit is 38,000 divided by 1900 units. So, rupees 20. Illustration 5. Next illustration. The process of manufacturing concern passes through two processes A and B and then to finished stock. It is ascertained that each process 5% of total weight is lost and 10% of scrap, which form process A and B, realize rupees 80 and rupees 200 per tons respectively. The following are the figures relating to both the processes. So, material for process A 1000, for process B 70, for cost per ton 125 for process A, for process B it is 200, wages 28,000 for process A, process B it is 10,000, manufacturing expenses 8,000 for process A, 5,250 for process B, output ton 830 for process A and 780 for process B. Prepare process cost accounts showing cost per ton for each process. There is no stock of work in progress in any process. So, I can create a process account, A account like this. To material 1000 units, 1,25,000, to wages 28,000, to manufacturing expense 8,000. By loss of weight, it is normal loss, so it will not be accounted for. By normal loss 10% 88,000, by abnormal loss 3,600, by output transferred to the next process it is 149,400, right. So, now it is now 149,400, 1,49,400 is now getting transferred to process B, right. So, in process B 1,49,400 transferred, material 14,000, wages 10,000, the manufacturing expenses 5,250, abnormal gains 3,150. So, by normal loss again 10%, it is 18,000, and by output transferred to the finished goods now 1,63,800, which is the balancing figure, right. So, we can create a finished stock account like this to output transfer. So, 1,63,800, the balance carried down 1,63,800. So, we can create an abnormal loss account, that is to process account 20 units, right. Amount is 3,600. By sale of scrap you got 1,600. So, loss transferred to costing PL, it is 2,000. Thank you.